as General Motors, once an automotive giant, is making headlines that will leave you astounded. Under the leadership of CEO Mary Barra, the company is making a bold move, pushing electric cars while seemingly neglecting their dependable gas-powered vehicles. But here's the kicker. GM is reportedly selling electric cars at a loss. This decision has sparked a series of problems, including low production quality, plant shutdowns due to low demand, and a massive $3 billion employee strike. So, what is Mary Barra's reasoning behind this electrifying gamble, and will it pay off? GM on the brink of a revolutionary transformation or teetering on the edge of disaster? Stay with us as we uncover all the details. In a move that has left experts and enthusiasts alike scratching their heads, GM has announced the discontinuation of its best-selling electric vehicle, the EV Bolt. But this decision is just the tip of the iceberg. According to an investigative report by Bloomberg, GM's EV division is facing a grim reality. It won't turn a profit for several years to come. Meanwhile, the financial burden of these losses is set to be shouldered by their internal combustion division, a move that has left industry observers baffled. The question on everyone's mind is this: why is GM pushing the EV agenda with such unwavering determination, even when it appears to be a financial quagmire? The answer to this question lies in a startling admission from none other than GM's CEO Mary Barra, who recently dropped a bombshell during the 39th annual Bernstein Strategic Decisions Conference. She candidly acknowledged that GM is currently incapable of turning a profit on their EVs, especially those priced between $30,000 and $40,000, a price range that could make EVs accessible to a broader market. What's more, GM seems to be charting a course that diverges from industry expectations. Instead of focusing on affordable EVs for the masses, they appear to be directing their efforts toward producing overpriced electric vehicles that can easily surpass the $60,000 mark. This approach raises eyebrows, as it deviates from the conventional wisdom that affordable EVs are the key to mass adoption. In 2023, GM set out to sell approximately 44,000 EVs, a modest target. However, the surprising twist is that they are selling these vehicles at a loss. This financial tightrope walk has raised concerns about the sustainability of GM's strategy, with questions about how long their IC division can continue to bankroll these losses. But amidst these challenges, there is a glimmer of hope on the horizon. GM is fiercely committed to slashing costs, introducing a new generation of Ultium batteries that promise to be significantly cheaper than their current counterparts. The next generation batteries, rumored to be around 40% cheaper, hold the potential to make EVs more financially viable. However, there remains a shroud of uncertainty surrounding the release date of these game-changing batteries. Mary Barra remains optimistic, envisioning a future where battery costs drop to approximately $87 per kilowatt-hour by 2025. Yet, she acknowledges the harsh reality that cost parity between EVs and IC vehicles may remain elusive until later in the decade or perhaps beyond. This situation places GM in a precarious position, especially given that the bulk of new car sales worldwide gravitate toward the $30,000 to $40,000 price segment, the very segment that GM currently struggles to make profitable. The road ahead for General Motors, G and the trunks in the electric vehicle market seems riddled with challenges, and the promise of profitability by 2025 is beginning to look like a daunting uphill battle. GM has set its sights on selling a staggering 1 million EVs annually starting in 2025, a goal that is easier said than done. Even industry leader Tesla took over a decade to reach that milestone. But here's where things get interesting. GM's current strategy involves selling their EVs at a loss, a financial conundrum that raises eyebrows and doubts about the feasibility of their ambitious plans. Furthermore, quality control at GM appears to have taken a backseat in their rush to dominate the EV market. A recent example is the recall of over 40,000 Chevrolet Silverado trucks due to brake fluid leaks that could potentially lead to fires. This is just the tip of the iceberg, as GM has issued a total of 4 separate recalls affecting 8 different models and more than 55,000 vehicles. These recalls not only pose a public relations nightmare, but also threatened to be a substantial financial burden, potentially costing the company millions, if not billions, in repairs. GM knows all too well the consequences of financial instability. In 2008, the company faced a staggering loss of $31 billion, equivalent to a jaw-dropping $85 million per day. Although GM has since recovered, the current challenges could potentially push the automaker back into a financial abyss. While GM grapples with these issues, other automotive giants are making moves. Tesla and Ford have joined forces, with Ford gaining access to Tesla's supercharging network. This strategic partnership could give both companies a significant advantage over GM in the EV market. Moreover, several other automakers are rapidly catching up in the EV race, making it increasingly challenging for GM to maintain any first-mover advantage it might have once held. GM had pinned its hopes on the Ultium platform and multiple assembly plants for EVs, including Factory Zero in Detroit. However, Factory Zero faced a major setback, remaining closed for the entire month of December last year. This disruption led to GM managing to ship a meager 86 Cadillac Lyrics and 72 Hummer EVs in the last quarter, despite having received more than 880,000 orders for these vehicles. It begs the question, what's happening behind the scenes at GM? Adding to GM's billion-dollar troubles is a standoff with the United Auto Workers, a union representing nearly 150,000 workers. UAW members walked off their jobs at 3 Midwest plants, demanding a 40% pay raise, a shorter work week, and the elimination of a multi-tiered wage system. The 40% figure is particularly striking when considering that the CEOs of GM, Ford, and Stellantis have seen their own pay rise by the same percentage in just 4 years. In 2022, GM's CEO, Mary Barra, pocketed an eye-popping $29 million, a 34% increase since 2019. Meanwhile, the average worker on the assembly line struggles to make ends meet. According to an analysis by the Anderson Economic Group, a strike by all auto workers could cost GM a staggering $5 billion after just 10 days. It's a significant sum, especially when you consider that GM, Ford, and Stellantis, referred to as the Detroit Three, are raking in massive revenues and profits thanks to consumers' appetite for pricey, tricked-out trucks and SUVs. GM alone earned a net profit of $10 billion in 2022. In the midst of a brewing storm at General Motors, it's clear that there's a glaring disparity between what the automakers can afford and what they are willing to share fairly with their workers. The situation is so stark that it has even drawn criticism from Ford CEO Jim Farley, who suggests that meeting the United Auto Workers' terms could potentially lead the company into bankruptcy. This stance appears baffling, considering GM reported a jaw-dropping $10 billion in net profits. This disconnect isn't just tone-deaf. It's an outright slap in the face to hard-working Americans who've struggled while these corporations rake in billions. Recent surveys indicate that nearly 75% of Americans support the UAW stand in the ongoing labor dispute. Even President Biden, often touted as a pro-labor president, has urged companies like GM to share their profits with their workers. The UAW finds itself with significant public backing and the support of the White House. But amid the labor strike, let's not forget the true victims here, the middle-class workers. They form the backbone of these automotive giants, yet they find themselves increasingly squeezed out. UAW President Ray Curry has labeled reports of planned layoffs of non-striking workers as an attempt by the automakers to force union members into accepting a weaker settlement. Curry firmly asserts that the UAW is prepared to go the distance to win both economic and social justice for its members. However, if this strike drags on, consumers could feel the impact. Vehicle shortages could emerge within a matter of weeks, further exacerbating the already high prices in a market where buyers are grappling with elevated borrowing costs. This isn't the first time GM has found itself in the crosshairs of labor disputes. A flashback to 2019 reveals that a UAW strike cost the company a staggering $3.8 to $4 billion for the year, a sizable dent in their financial armor. The strike, which lasted 40 days, stands as the longest national walkout against the automakers since a 67-day strike in 1970. Meanwhile, the automotive landscape has seen significant changes. Between 2017 and 2022, the share of new auto sales priced above $60,000 tripled from about 8% to 25%. The average price for a new car surpassed $49,000 by the end of 2022 compared to just $39,000 3 years earlier. The money is undoubtedly there, but it's not trickling down to the workers who make these profits possible. GM's response to the labor dispute has been to offer what they deem an unprecedented economic package, including historic wage increases totaling 20%. However, it's essential to put this figure in perspective. A 20% wage increase pales in comparison to the 40% pay raise that GM's CEO, Mary Barra, has seen over the last 4 years. Adding to the complexity of the issue is GM's clever financial maneuvers. Mary Barra, who currently earns almost $30 million, defends her compensation by highlighting that 92% of it is performance-based and tied to the company's stock performance. This approach not only inflates her earnings, but also enjoys a lower tax rate compared to a regular salary. Furthermore, GM has engaged in stock buybacks, a tactic that artificially inflates stock prices, benefiting Barra's performance-based pay while doing little for the average worker. It's a classic case of corporate manipulation that funnels wealth to the top while the rest of the workforce faces financial challenges. So here's a message to Mary Barra and other CEOs. The middle class has reached its breaking point. It's time to share the pie before the whole system crumbles. If GM believes its current problems are significant, just wait until its workforce turns against it. That's not merely a problem. It's a catastrophic disaster that could potentially bring down the entire company. The clock is ticking and the stakes have never been higher. So, do you think General Motors can revive their brand once again with these new strategies? Share with us in the comments below, and if you enjoyed this video, show us some love by hitting that like button and leaving a comment down below. Also, if you're a fan of all things technology, be sure to check out this other video we've got lined up for you. It's packed with all the latest news, tips, and tricks to keep you ahead of the curve.